It may be Australia's biggest natural disaster, but the floods have yet to change the Reserve Bank's thinking. As expected, the RBA kept official rates on hold and reserved its final judgment on the flood's impact. That final judgment could change if the latest business survey is any guide. Here's Philip Lasker.
The devastating floods may have blown a state economy and many thousands of lives way off course, but not the Reserve Bank.
Well, the Reserve is basically saying that there will be a short-term adverse impact on both prices and growth. But it's essentially saying that it's prepared to look through that. It'll focus on the medium-term outlook for the economy, and on that basis it doesn't see a major impact coming through from the floods.
While the RBA acknowledges it's too early to be sure, its preliminary assessment is that overall demand from the rebuilding effort in Queensland is unlikely to have a major impact on the medium-term outlook for inflation. So, as expected, the cash rate stayed at 4.75%.
I think that they're very concerned about not overestimating the impact of the floods and its impact on overall the economic performance for 2011 in particular.
The RBA would have seen an improvement in business conditions in December's National Australia Bank survey, with rises in trading performance, profitability and employment. But the floods were beginning to dent confidence.
We were very concerned in terms of what it was showing. I mean, you look back and you can probably understand why confidence is so bad, but we were also a little bit surprised when actual activity levels were as bad as what they were in Queensland.
While the nation's business conditions improved, Queensland's confidence and conditions measures plunged to levels not seen since the height of the global financial crisis. And the January survey, which will include flooding in Brisbane and Victoria, is yet to be seen.
In the short term, the disruption effect is probably going to be larger than what Treasury said. Treasury talked in the financial year of a detraction of around about 0.5%. We're talking around about 0.8, 0.9 detraction.
Manufacturers have been battling more than the floods. A key manufacturing index was below 50 again in December for the fifth straight month, which means the sector continued shrinking. The Australian Industry Group says it's a symptom of a strong Australian dollar and wage pressures hampering growth as manufacturers compete with the mining industry for workers. As far as the Reserve Bank is concerned, the resources boom is still the main game.
There's short-term impact, but the long-term global impact of demand from China and India ultimately is more important, and that's why Australia is in good long-term shape.
And that's why interest rate forecasts haven't changed much despite Mother Nature's intervention.
We were looking at a tightening in the next few months sometime. Now we're looking at a tightening occurring maybe around May or the middle of the year.
Having kept a lid on the economy through last year's rate increases, the RBA has bought some time so it can easily afford to play a waiting game.